Hello and welcome to the third instalment of our Investment Insight series, Magellan Minutes. We aim to bring our investors relevant, timely and thought-provoking investment insights, all within around 10 minutes. It's been great to see the positive feedback we've had since we released this series about a year ago. A lot has happened since we last caught up in December, with the vaccine rollout well underway globally, and also the effects of the stimulus packages we've seen washing through the system. From ESG to infrastructure, luxury to financials, we discuss the issues and developments in the sectors and the stocks in our global portfolios. My name is Jennifer Herbert. I'm Key Account Manager at Magellan, and today I'm speaking with Ryan Joyce. Ryan is our Head of Technology, Communications and Media. Today we'll be discussing investment issues facing Netflix and Alibaba, the implication of the G7 tax deal, and one of Magellan's lesser known holdings, which is Crown Castle. Thanks for joining us, Ryan.
It's a pleasure.
Ryan, Netflix has traded sideways since mid-2020 and saw a meaningful slowdown in subscriber net adds in Q1. Has this caused you to revisit your investment thesis on Netflix?
Look, the first thing I'd say is that Netflix is really viewed as a 10-year type investment. So we're not measuring results over a 6 or 12-month period. And if you look back over its history, it's actually had periods where it's done not a lot for quite an amount of time. But if you measure it over that past 10 years, it's delivered a 30% CAGR, which is very impressive and attractive. Now, you also asked about whether the slowdown in net adds has caused us to revisit our investment thesis. And the simple answer to that is no. We think the slowdown is really short-term noise driven by COVID. And there's two main factors at play here. The first is we had a pull forward of streaming adoption during COVID when people were locked at home. And we also had less churn of existing users given how much content they were watching. The second component is the impact COVID has had on content production. You can imagine that creating content, bringing people together in different locations is a big challenge during COVID. And so the result of that has been that there's less new content being released in the first half of 2021, which is key to driving subscribers. The other thing they've done is pull back on marketing spend. The marketing they spend is typically tied to that content and aims to create buzz around it. So it doesn't make sense to do it when they're not releasing that new content. Now, as those dynamics normalise over the next 6 to 9 months, we'd expect their subscriber growth to re-accelerate towards pre-COVID levels.
Shifting to Alibaba, which has been in the headlines for a variety of reasons over the last 9 months, is Alibaba still a good investment?
Yeah, great question, and it's certainly been a challenging 9-month period for Alibaba, and I'd group those challenges into two main buckets. One is government regulation and the other is competition in e-commerce. And before going into those in a bit more detail, I would say that we think those challenges are more than reflected in its current share price, and so we do think it's an attractive investment. Now, in terms of the government regulation, we saw the anti-IPO pulled, we've seen an antitrust investigation and a fine, and we've seen governments protecting SMBs. Now, it's easy when these things are happening in China to kind of overreact and become overly concerned. And while there are some risks here that we need to think about, it's also true to say that a lot of this is similar to what we're seeing in the rest of the world, and it's also sensible. If we think about the antitrust investigations of Chinese tech platforms, this is exactly the same as what we're seeing in the Western world. If we think about the protection of SMBs, the pace of change in China is just incredible at the moment, and we think it makes sense for the government to step in and moderate some of that pace of change where the impacts are being particularly felt.
So what about the competitive issues in e-commerce that you mentioned?
Yeah, so there's really two dynamics at play here. The first is there's this race in China for the next 400 million consumers in lower tier cities that are yet to adopt e-commerce. And while Alibaba's core marketplaces in Taobao and Tmall are very popular in those higher tier cities, it is much more competitive in those lower tier cities. The other dynamic is that as e-commerce penetration continues to increase, we're seeing the emergence of new channels for e-commerce, whether it's short video or social platforms, and allowing transactions to be completed on those platforms. And so in response to that, we are seeing Alibaba increase investment. We're seeing it increase its investment in grocery, which is a pathway to other e-commerce categories. We're seeing investments in live streaming and in acquiring customers in those lower tier cities. Now, that's obviously having an impact on near-term profit growth, and it's something that is weighing on sentiment. But ultimately, we think, given the scale of the opportunity here, it's absolutely the right thing for management to be doing. And so that supports our view that we view it as an attractive investment.
Ryan, another topic that's been in the news recently is the corporate tax and the recent G7 deal. So what are the implications for Magellan's larger tech holdings?
Maybe taking a step back and thinking about the objectives of the G7 tax deal, and they're really twofold. The first is to reduce the benefit of booking profits in low tax jurisdictions like Ireland. And the second is to ensure that highly profitable global multinationals, many of which are tech companies, pay tax more aligned with where they generate their revenue. And at a high level, we think those are quite sensible policy objectives. Now, there's still some details to be hashed out, and some other bodies need to be brought on board in terms of the G20 and the OECD, but we do think they'll get there. Now, in terms of the impact for some of our holdings, I would say this is something that we've been anticipating for some time. And so in that respect, we don't really view this as a negative incremental impact, even though we do expect a modest rise in corporate tax rates. And we've actually seen Alphabet and Facebook come out in support of the G7 tax deal.
Let's shift our focus to Crown Castle now. Crown Castle sits just outside our top 10, but it's one of our strong performers. How much of that has been related to 5G, which we hear so much about?
Absolutely. Maybe just for the benefit of the viewers, I'll provide a bit of background on Crown Castle. And Crown Castle's main assets are 40,000 towers in the US that wireless operators lease space on to hang network equipment and radios and antennas. And why we really like Crown Castle is that as the demand for wireless data continues to increase, those wireless carriers need to put more equipment on more of those sites to meet that rising demand. And that's a trend that's really been in place for the past 20 years or so. Now, in terms of your question around 5G, that's absolutely been a contributor, but there's actually a number of factors in the US that have contributed to the strong outlook for Crown Castle. And taking a step back, you may remember this whole race to 5G, particularly in the context of the US versus China. And the reason for that is that the dominance of US tech firms is partly viewed as being driven by the early investments by the US in 3G and 4G. And so 5G is kind of viewed as the next evolution of that, and therefore highly strategic. Now, the difficulty with rolling out a 5G network is that, one, a lot of people don't have 5G phones yet. And two, the spectrum the carriers do have is being used for 4G, and it's difficult to repurpose that. The other factor is that to get the full benefits of 5G and unlock that next round of innovation, you need bigger bands of spectrum or bigger pipes to carry that data through. And so what we've seen governments around the world doing is repurposing existing spectrum and auctioning it off to the wireless carriers. And they're doing it in what is called the mid-band range. Now, the US was a bit slower to this than some of the other countries, but they carried out their spectrum auction in 2021, and the proceeds from that auction were $80 billion. That was mainly from Verizon and AT&T, but it really highlights how valuable that spectrum is for these 5G networks. The other dynamic that's been at play in the United States is you had T-Mobile acquire a competitor in Sprint in early 2020, and Sprint actually had a large amount of this mid-band spectrum that it wasn't really using. And so T-Mobile was able to start deploying that spectrum ahead of its competitors and then market that network advantage in 5G. And so fast forward to today, and what we have is you have T-Mobile continuing to deploy that spectrum that it got with Sprint, and then you have Verizon and AT&T getting ready to deploy the spectrum they acquired in that auction. And on top of that, you also have a new entrant in that market in Dish that's also looking to build a network. And so this is really a perfect storm for Crown Castle. Not only when they're deploying that spectrum do they need to add more equipment to all their existing sites, But mid-band spectrum doesn't travel as far, so that means they need to add a whole lot more sites and densify that network. And so that gives us very strong visibility into growth over the next 5+ years.
Ryan, thank you for your insights today.
It was a pleasure. Thanks.
And thank you for joining us. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Thank you.